Good day, everyone. Welcome to our webinar for the month of December, our last webinar for this year. The next one will be in February of 2020. As usual, I like to begin in America. So if you look at the chart on your screen, you can see that the S&P 500 has made a strong upside break here, culminating on Thanksgiving Day, which is these two green candles at the top. We always repeat the candle on a public holiday. So the second green candle is Thanksgiving Day. And then you can see that straight after that, the upward trend was broken by these two downward candles, including last night's quite hectic 1.3% drop. And that was, of course, due to two things, I think. Firstly, the publication of the impeachment document by Congress in America, and secondly, by Trump's new bout of sanctions and tariffs against China and also against Brazil and Argentina, and he's causing the market to come off a bit. But as you can see, last night's candle is what is called a hammer, where the body of the candle, the little green square there, is less than half the downward tail. So you've got a long downward tail and a small body. That is generally quite a bullish candle to see, and usually you should see an upward move following on from that. Candlesticks are quite reliable in this regard. So what has happened here on that day, yesterday, that's last night on Wall Street, is that the bears tried to take the market right down to this bottom level here, which is the end of the tail, but they failed. And the bulls managed to not just pull it up, but to even take it into positive territory. So that shows that the bears failed in their attempt to drive the market down, and we actually ended up with an up day from a candlestick point of view, a green candle. Of course, we're now past October. October is always a little bit of a worry for investors. The main bear trends of October 1987 and October 1929 are always in investors' minds, so everyone is always a little relieved when October is behind us. And generally speaking, the market goes into a Christmas rally over the December. In fact, the S&P on average gains about 1.7% in December month. And now we are 4% above the previous cycle high, which you see over here, which was at 3025 in July. We are 4% above it at this Thanksgiving close. In September quarter, the U.S. economy grew by 2.1%. That might not sound like a great deal, but you must remember it's the biggest economy in the world by a pretty big margin. So it's actually a massive growth. And you must also remember that it's been expanding for 10 years now, since March 2009. So the growth is getting pretty impressive. Next year, of course, is 2020. It's an election year. Trump is busy facing impeachment proceedings, and Congress just produced a 300-page report on his impeachment, and that may be one of the reasons why the market fell last night. And of course, the economy is his big win. That's Trump's big claim to fame. He is saying that he is completely responsible for the bull trend in shares. He's responsible for the economy booming. And that is the one thing that he can really crow about and does crow about. Of course, we know that the economy has been booming for 10 years, long before he even considered running for election as president. So the boom is really not a great deal to do with him. He did have an impact through his tax cuts at the beginning of 2018, but since then his impact has been probably more negative than positive. However, that doesn't mean that people will not vote for him in America. They will vote for him because he is the one who is seen to be driving the American economy at this stage. Remember, America has record low unemployment rate at below 4%, and wages are starting to creep up there. as a result. In November month, the S&P 500 gained 3.4%. So that's this strong rise here that you see here. Donald Trump is busy trying to derail that for some reason. He signed a bill supporting the Hong Kong protesters, which obviously doesn't make China very happy. And he's issued new sanctions and tariffs against other countries, including France, I believe, is now in his sights. The people who are negotiating in China are trying to structure a deal before the 15th of December. And if they fail to do that, additional US tariffs will kick in. All right, so that's what's happening in America. We are still of the opinion that this here is just a short-term correction and that the market will rally. It will make a high above the Thanksgiving Day high here, which is at 3153, and will go on upwards in the bull trend. All right, let's turn to South Africa now. And I'd like to just look at a few developments on the political front because it's been quite an exciting month. The first thing I'd like to talk about is the fact that the Zuma period of 9 years while he was in power was marked by appointments based on political reasons. Candidates were chosen for their loyalty to Zuma and the Guptas and for their readiness to get involved in state capture rather than on their competence and their dedication to the country. Ramaphosa has been slowly removing the Zuma appointments and putting in suitable alternatives. He's looking for people who are competent, diligent, and honest. But sometimes he is forced to appease the opposition within the ANC, and that has happened recently with the appointment of Batabile Dlamini, who's been appointed as the chairperson of the Social Housing Regulatory Authority. This is not a very significant appointment, but obviously in first world countries, once you have been found to have lied to the highest court in the land, you're unlikely to get any government appointment whatsoever. But it seems apparent that despite her lies to the Constitutional Court, Ramaphosa felt the need to throw her a bone, and he's therefore given her an appointment. At the same time, and in the same month, it was decided to appoint De Ruyter as the CEO of Eskom. This came as a significant surprise for most people. It shows that the ANC government under Ramaphosa is willing to appoint whites if they are considered to be the most competent or the best person for the job, and that they are not slavishly following the needs of transformation. They are more concerned about who's going to be able to turn Eskom around and make it work. Obviously, De Ruyter's survival depends on the government's support, and he has taken a significant cut in pay to take up this position, which means that he's not doing it for financial reasons. He's a highly respected executive who was the CEO of Nampak, and clearly he could have got a much more lucrative job if that was his intention. So he's doing this for altruistic reasons. And then the third thing which happened was that Bongani Bongo has been arrested, and he is facing charges. And Bongani Bongo is a very significant person because he is a member of the National Executive Council of the ANC. And that's the most powerful body in South Africa. They can recall the president. But he's been arrested, and now there is significant pressure on him to resign his position on the NEC. That pressure is coming from the ANC veterans, amongst others. He's being pressured to step down. And this is an example of Ramaphosa's policy of allowing the media and the justice system to remove his opponents. That policy is slowly taking effect. Obviously, he appointed Batohi as the head of the National Prosecuting Authority, the NPA, And then he gave her in this last budget an extra 1.2 billion rand to pursue all the crooks. And of course, Zuma, as we see now, is mired in litigation, which is no longer being paid for by the state. And the EFF is tied up with the VBS Bank matter. And now Bongani Bongo has been arrested. So Ramaphosa doesn't involve himself directly in these matters, but I think this is his strategy. Many are concerned that Ramaphosa is moving too slowly. But we are seeing a steady increase, in our opinion, in his power and influence. Turning our attention to the economy, the midterm budget, of course, was disastrous. The deficit is now growing towards 80% of GDP over the next 10 years, and that amounts to a debt trap. So the economy is heading into a debt trap. It's a very similar position now to the one which the ANC inherited from the National Party in 1994 when they took power. Of course, at that time, they appointed Trevor Manuel as the Minister of Finance, and over the next 14 years, Trevor Manuel managed to reduce the government's debt from around 80% to about 20% of GDP. The Zumas and the Guptas managed to take it back to 80%. And that is very depressing, I'm sure, for Trevor Manuel and for other law-abiding South Africans. It's going to require some sacrifices to get the budget deficit down again. And it's a politically delicate situation for Ramaphosa. There are still many rent seekers within the government who, and of course there's a deeply rooted culture of dishonesty and entitlement, which is rife at every level of the civil service. The Reserve Bank, though, however, has made it quite clear that they've got no intention of printing money to fix this problem. What is required now are sharp cuts in the civil service and probably privatization of various SOEs, of state-owned enterprises. The alternative is a Zimbabwe-style descent into economic chaos. Of course, the best way to deal with the economy is to encourage overseas investment, foreign direct investment, or FDI as it's known. That is the shortest route to economic recovery. And Ramaphosa held his second investment conference and secured promises for 371 billion rand of investments, about 25% more than the last conference. However, much of this investment was already committed, so it doesn't really significantly move the needle. Ramaphosa says that 412,000 new jobs will be created. However, in our opinion, the real solution is to create an investment-friendly environment where overseas money wants to come to South Africa and it's not necessary to hold investment conferences to encourage it. Then there will be no more need for these conferences. Ramaphosa says that South Africa is firmly on the road to recovery. Not quite sure where he gets that from, considering that the latest statistics show that the South African economy shrank again by 0.6% in the third quarter, mainly because of a 6% drop in mining output. South Africans are not too impressed with this kind of thing. They've endured many setbacks. What we want to see is real growth in the economy, and that can only come about if an investment-friendly environment is created. Of course, hanging around in the wings is the ratings downgrade by Moody's. We think that this is more or less a certainty. South Africa will be reduced to junk status. The question really is only when. The most likely timing, as far as we're concerned, is probably after the February 2020 budget. This year, growth is probably not going to reach the 0.5% which the Treasury has predicted. Now that we've got the third quarter growth coming in at minus 0.6%, it's highly unlikely. So far, in the first 9 months of this year, the economy has grown by 0.3%. So we would need to have a really powerful December quarter to get it up to 0.5%. All right. If there is a ratings downgrade, we can expect anything between $5 and $10 billion to leave the country. The rand is expected to fall to around 16 rand to the US dollar. Of course, a weaker rand makes exports cheaper on world markets, but imports, including petrol, will become more expensive. And I think that the real problem here is that Ramaphosa's reforms are just too slow for Moody's and the other ratings agencies. A downgrade will make it much harder for South Africa to claw its way back to a sort of 3% growth rate. A big problem in all of this is the government's wage bill, which is 35% of its total expenditure and 46% of the total amount of tax collected. South Africa simply cannot afford this inefficient civil service of 1.2 million people. Civil servant wages have increased by 66% in real terms, that's after inflation, over the last 10 years. The latest increase last year in 2018 was 6.8%, 2.2% above inflation. Ramaphosa says that the government wage bill will be reduced, and he says it will be done without retrenchments. We see that as highly unlikely. And again, we point to an inevitable conflict between the government and the unions at some point in the future. In October month, inflation fell to 3.7%. This is obviously a direct reflection of the very low level of consumer spending. Of course, there should have been a rate cut in November, but the Monetary Policy Committee was worried about a ratings downgrade. We think, however, that interest rates should be cut, and they should be cut by at least 50 basis points at this stage to stimulate the economy. Then, of course, SAA has been much in the news. We agree with Tito Mboweni, it should be folded or sold. The latest 5.5 billion rand injection, which they got earlier this year, has proved to be insufficient. They're now asking for 2 billion rand more. So far, up to now, SAA has had 28 billion rand in injections from the government over the past 13 years. Now they want 2 billion rand more. The strike has been averted, but at what cost? If SAA was folded and sold off, a message would be sent to all SOEs that they cannot simply rely on government support indefinitely. We think that's a very important message that needs to be communicated. Looking further afield, the closure of the Saldanha steel plant by ArcelorMittal is a tragedy. It will see 900 jobs lost, and mainly that is due to the cost of electricity. The high cost of electricity, which has risen by more than 500% over the last 10 years, is really causing big damage to the South African economy. So it's not enough to keep the lights on. Electricity must also be reasonably priced. Otherwise, big projects like Saldanha Steel have to close because they are not economic. We see this as part of South Africa sinking slowly towards the level of its incompetence. The real question is, where will we find a bottom? Of course, all of this is reflected in the rand. So I'm now going to switch to a chart of the rand here, so that we can look at that. That is a barometer of what is going on in South Africa. I should put a 2-year chart here. And really it reflects the South African economy, but it also reflects emerging markets in general. It is one of the most heavily traded currencies in the world, with 50 billion rand a day changing hands. International currency traders like the rand because they can get into it and get out of it very easily. So the rand responds to any emerging market news, whether good or bad. It is also sensitive to the risk-on, risk-off situation with international investment sentiment. So when Trump declares a trade war on China, then that has a direct impact. It pushes overseas investors towards risk-off, which means they withdraw their funds from emerging markets and put them into first world treasury bills. That has a negative impact on the rand. Obviously, when things are going well from the trade war perspective, we move back towards risk on, and funds flow out of America and Europe, and they are in search of the high yields which South Africa can offer. Then the rand is obviously benefited by that. The rand is also obviously impacted by local factors. The initial reaction to Ramaphosa's appointment was very positive. And it caused the rand, you can see down here in March of 2018, we were trading with a rand of 11 Rand 60 to the US dollar. Since then, it has weakened significantly as the realities of the Zuma years and the cost of the Guptas and state capture have sunk in. And it has found a support level here at around 15.50 to the US dollar. You can see that support level is backed up over here. And there's the budget. You can see the budget. I've marked it here on this chart. And things have been trending positively since then, including last night and this morning. And the rand is now trading at 14.61. So it looks like it may break below this double bottom here and strengthen even further. That's good news for South Africa because it basically means that the ratings downgrade, if it occurs, is probably very much discounted into markets already, and people are not very scared of that. And in fact, they're looking for positive news. Of course, all of this has an impact on the JSE. The JSE is discounting bad news and good news all the time. The shares on the JSE are generally cheap. If we go to the JSE overall index, you will see what I mean. All right, I'm going to put 5 years data on the screen. You can see here that starting from about 2018, the JSE has been drifting sideways and downwards, right? And to make that a bit more graphical, I'd like to just do a comparative relative strength of the JSE against the S&P, the S&P 500, because I think that shows this quite clearly. Okay, I'm going to just push this right up so that all we can see here is the comparative relative strength, and I'm going to put 10 years data on the screen. And what this shows is that for this first period up to the end of 2015, so up to the beginning of 2016, we were holding our own with first world markets. But after that, this new downward trend came into play. And here you can see that there's no doubt that we are underperforming world markets. So the world markets are going up. They're in a bull trend. And South Africa is battling to follow them upwards. However, that does mean that our shares are relatively underpriced. The JSE overall index is sitting on a price earnings ratio of 16. And we see that as relatively cheap. And that, remember, is despite the fact that we've got some huge international companies like Naspers, British American Tobacco, Anheuser-Busch, and others in the index. But it's been underperforming for 3 years. So it's a time possibly to look for opportunities, because we believe that sooner or later the JSE overall index will follow the world markets upwards. Okay, I'd like to just look at a couple of general points that occurred during the last month. The most important of these is the agreement that was struck in the platinum sector between the platinum employers, the mining companies, and the unions, between AMCU, the major union in the platinum sector, and the platinum mining companies. Now, what happened here, the settlement was struck at 5.5%, basically a 3-year deal. And you have to bear in mind that the unions were initially demanding 48%, and they obviously have had to back down. They have no stomach for an extended strike, having just lost in their strike in the gold industry, where they went on strike for 5 months and then had the humiliating experience of having to accept the deal that was made and agreed with the other unions. They had no real stomach for doing the same thing in the platinum industry. So Matunjwa, I think, who's the president of AMCU, has lost a considerable amount of his face and political clout. And most of this is thanks to the efforts of Neil Froneman at Sibanye, And I even see now that there was a report the other day that COSATU is willing to accept the principle of privatization for some of the state-owned enterprises. So maybe a little reality is creeping in. Another piece of news under general is that Pepkor has decided to close its last remaining 20 stores in Zimbabwe and to withdraw from the country. The situation there has become untenable for them because of the hyperinflation in that country and the fact that they can't repatriate their profits. It's interesting that Pepkor originally had over 200 stores in Zimbabwe, and obviously the closure of all those stores has involved a lot of job losses. It's damaged the economy. There are lessons in this for South Africa. The first lesson, of course, is that with the economy of Zimbabwe being in such a powerless state, there is going to be a lot more illegal immigration into South Africa, which has an impact on housing, on the crime rate, and so on and so forth. The other thing that South Africa should learn from this, and particularly the ANC, is it is a stark warning of what can happen to an economy which is not run along rational lines. We could end up in the same situation as Zimbabwe. All right, so let's turn our attention to the companies. The first company I want to look at is Resilient. Here we go. Obviously, this is a company which is in the property sector. Just going to put a bit more data on the screen here. There you can see the position. I've put on a 65-day exponentially smooth moving average, and I've identified a resistance line here at about 68 Rand a share. But you can see Resilient has been trending up for some time, since March. Now it has finally been cleared of all wrongdoing. There's no insider trading. There's no share manipulation. And we see this as a recovery stock. Don't forget that the share was 147 Rand over here in December 2017. And it is now trading for about 67 Rand. So it's about half price. It's trading close to its net asset value, which is 69 Rand, and we see that this resistance line will be broken. Remember that it's always a good idea in the share market to buy a share where you can see a mountain behind you. You can see this big mountain behind you. You're down here by the river, and you're not paying top dollar. Out there is somebody who filled his pockets with these Resilient shares at 147 Rand. And if you buy them for 67 Rand, you'll be doing a hell of a lot better than him. All right, the next share I want to look at is the Foschini Group. We have looked at this company before, but it's a really great share, and I'd like to draw your attention to it. Obviously, it's in a very difficult market because the retail trade in this country is difficult. We know that because consumer spending is under such a lot of pressure. I'm just pulling in a bit more data so that you can see the long-term picture here. But essentially, Foschini has been in a steady upward trend right through that 10-year period that Jacob Zuma was in power. Consumer spending has been continuously under pressure during that time. You should understand that this company sells more than 28 fashion brands in 32 different countries, but its main activities are in the UK, in London, and in Australia and South Africa. Unlike many other retail companies, they managed to set up a successful business in Australia. So Woolworths has really taken a hit there, but Foschini managed to do it successfully. They've been a particularly consistent performer, and in the last 6 months to the 30th of September, their turnover was once again up 6%. Headline earnings per share were up 3%. What is interesting about this company is that they've established systems that enable their factories to produce changes to fashion very quickly. And they have much better working capital management. Obviously, the fashion industry is a difficult industry because things are changing there the whole time. And as they change, you need to get new stock into your stores as quickly as possible. So what Foschini has been doing there to shorten this lead time for getting new fashions from their factories to their stores is having a big impact on the company. They're sitting on a price-earnings ratio of 12.85 and a dividend yield of over 4%. We think this share is cheap and a good buy. Of course, during the month, we had the unbundling of Remgro and RMBH. And we've also recently had the unbundling of Naspers. So I just wanted to talk a little bit about this. When a company, a big multinational conglomerate, unbundles, what it means is that it takes one of its subsidiaries and hands the shares in that subsidiary to its own shareholders. And in that way, it steps out of the picture, and its shareholders now become the shareholder in that subsidiary directly. So now, the first thing that happened was that long ago, Rembrandt split out from Rembrandt, and it was used as a vehicle to control the Rembrandt Group's South African assets. The overseas assets were housed in Richmond, and both companies, of course, are listed on the JSE. Rembrandt itself was originally formed in 1941 by Anton Rupert, rolling cigarettes in his garage, and it built itself up into a massive tobacco company. In 1995, Rembrandt and Richmond combined their tobacco interests to create British American Tobacco, or BAT, which is also, of course, listed on the JSE. Remgro was left with many big and important South African companies. You may, of course, know that Remgro was involved in setting up Vodacom. It's also had a big share in Distel. Remgro has unbundled its 28.2% share of Rand Merchant Bank Holdings now. And Rand Merchant Bank Holdings, in turn, has unbundled its 34.1% stake in First National Bank. This will release a lot of value into the hands of shareholders. It's interesting that when Naspers unbundled MultiChoice onto the JSE and separately listed it, it released $4 billion of value. Similarly, when it unbundled Prosus and listed it on the Euronext in Amsterdam, it released $10 billion of value. So people who are holding Naspers shares have had literally a windfall, and the same is true for Remgro and RMBH shareholders. Both shares, Remgro and Naspers, remain among the best investments on the JSE. Okay, during the month I was interested to see Pretoria Portland Cement, PPC, battling again because of imports of cheap cement, mainly from Pakistan. Between January and August this year, cement imports rose by 5%. I'm always amazed by this because cement is a high bulk, heavy, low value product. How is it possible for the Pakistanis to make cement and transport it to South Africa for prices below what our South African producers can make it for? That doesn't seem sensible to me. It doesn't seem to make sense. So that is the question. Of course, one of the key factors here is once again Eskom. The 500% rise in electricity prices over the last 10 to 12 years is making our businesses in South Africa uncompetitive. And PPC is one of them. Of course, the CEO of PPC and other cement producers are lobbying the government to put tariffs on Pakistani cement. But the real problem is probably Eskom, amongst other things. And if we can't produce cement in this country as cheaply as the Pakistanis can make it and get it over here, then maybe we shouldn't be in the cement business. One thing I can tell you, South African consumers are benefiting from the cheap cement that they can get in South Africa, and which is imported. The PPC share price has been hammered over the last 12 years. If you look at the long-term chart of PPC, which I'll go to now here, you can see how this share used to be one of the best performing shares on the JSE up until July of 2007. And of course, with the subprime crisis, it's just been hammered down to current low levels around 340 cents a share. We do not think that this is a good buy. We think that the share will continue to be depressed. The next share I want to look at is a much nicer share. It's Lewis. Lewis is, of course, in the furniture business. They sell relatively cheap furniture to the lower income groups mostly. And it's a company which has seen a bit of a knock. The reason for this knock was that it has come under the scrutiny of government for its practices in credit, in issuing credit and credit insurance. And in 2015, it fell quite heavily. And as you can see, it reached a low point here in December 2018 at around 25 Rand. Since then, it has been slowly recovering, but right now, it's starting to look pretty good. You must remember that this company has 780 stores around South Africa mostly. 116 of them are in African countries to the north of us. About 65.7% of its sales are made on credit. So they're selling cheap furniture to the lower income groups on credit, and they are obviously very sensitive to the state of the South African economy. People don't buy furniture in recessions. And what is interesting about this company is its results for the 6 months to the 30th of September this year. There they had turnover up 6.1% and headline earnings per share up 18.9%. So that's a fantastic result. And if you look at the share right now, it's trading on a price earnings ratio of 7.8% and a dividend yield of 6.2%. So it looks pretty cheap. The net asset value is 60 Rand, but the share is trading for 31 Rand. So you're getting it for half price. There's obviously strong support around the 26 Rand level, and we think that this share is poised for a new upward trend, especially if the South African economy starts to recover to any extent. The next share I want to look at is Pepkor. Of course, Pepkor, the key thing about Pepkor is that it is 71% owned by Steinhoff. And you can see with the Steinhoff debacle over here, you can see the share took a hell of a knock. And since then, it's been basically trending sideways, sitting at about 17 Rand a share. Of course, we think that Steinhoff 71% will eventually be sold, but that doesn't really impact directly on Pepkor. Pepkor is an excellent business. What I was interested to find out about Pepkor is that 96.5% of its products are sold cheaper than any other store in South Africa. That's a remarkable record. And this is in the cutthroat textile industry and the clothing industry, where we know that there's a tremendous amount of local competition. There are overseas companies like H&M and Cotton On coming into this country. But Pepkor is known to be the cheapest. There's just no doubt about it. They are very, very strong in the low income groups. In the 6 months to the 30th of September 2019, their turnover was up 9% and headline earnings per share were up 16.7%. That's a fantastic result. They opened 338 new stores in that time. So they now have 5,415 stores. And you can see here there's a little bit of a double bottom picking up here in the chart and a new upward trend. We think that this share is good value, despite the fact that Steinhoff owns it. We predict that Steinhoff will sell at 71% at some time in the future, and Pepkor will basically be independent of that problem. Finally, I'd just like to have a quick look at Sasol. Sasol, as we know, is a massive international chemicals and energy company. Roughly half of its profits come from oil or oil-related products. The big news about Sasol, of course, is that it's got this Lake Charles chemical project, or LCCP, in America, in Louisiana, which it's been building, and unfortunately that project has gone over budget and it's late. But it is potentially a game changer in the booming US economy. The share price is impacted also by the strength of the Rand. As you can see, the share has fallen quite heavily, well below this support level here at about 380 Rand a share. It's now trading for about 250, and it's on a price earnings ratio of about 8.5, and we think that it could be close to a bottom. So obviously it's highly risky because it's linked, it's partly a commodity share, 50% a commodity share, and secondly because It has this project in the US which has been badly managed. The board of directors has been changed now, and we see some potential in the share, and we think it's relatively cheap at current levels. Folks, that kind of covers it as far as we're concerned. Thank you for listening to our webinars this year. We hope that you've derived some value. We wish you all the best for the festive season. We believe that 2020 will be a good year for stock markets, mainly because it's an election year in America, and I'm sure Donald Trump will want the stock market to go up to improve his chances of winning a second term. Otherwise, we wish you all the best for the festive season once again, and we'll talk to you on the first Wednesday of February 2020. Thank you.